Hey everyone, Meet Kevin here. So I'm in Bakersfield because we have a rally tomorrow. If you want to come, go to meetkevin.com. Bakersfield rallies can be great. But I want to talk a little bit about housing and real estate. So I've mentioned in prior videos that not only am I a little bit nervous about a slow bleed in the stock market, but I'm also starting to see a little bit of an inflection point in real estate. And so I want to talk about real estate and my strategies going forward a little bit. I do believe I owe you a little bit of clarity on what I said yesterday. Some folks were saying, hey, wait a minute, Kevin, don't you still expect rallies coming? That is like rallies in the stock market by September and October. And I do. I still personally, this is just my personal opinion, and I know about 50% of folks won't believe with this, but at least you know what my opinion is, right? And then you can build perspectives from there. But I still think it's likely that when we see inflation data actually start coming down, which I don't think we're going to see in August, I don't know that we're going to even see it in September. It's really the September-October readings, which come out in October, November. That's when I kind of expect some rotation down in inflation readings. Then I do think there will be some form of a rally in the market. The problem is from like what level and how much of a rally. Based on what I've seen the last 5 months, I think the rally is going to be much more muted. I don't think we're going to see some of these September, February highs as soon as maybe we've been expecting or hoping to anymore. Sort of just those thoughts. So I still think we're going to see excitement, some potential euphoria. That's when you dump your call options, right? But I have dampened my expectations for how much of a rally I expect to see, how soon. And I think that's worth noting because you don't want to wait for like, oh, well, no, I'm waiting to get back to this level or whatever. I don't know. That might take longer than we think. Okay, so you have an update on, first of all, where the heck I am. The second of all, on my thoughts sort of on the stock market. And in prior videos, I've talked about this inflection point in real estate. In fact, I've been talking about this for about the last 3-4 weeks now. And this inflection point is really this decline in all of a sudden, well, let me put it this way. We're seeing an increase of new listings. We're seeing new listing asking prices go up, but we're actually seeing pending sales decline sharper and sooner than we would expect. Compared to at least 2018, 2019. We're seeing that pullback sooner. I think that is going to put some potential downward pressure on the real estate market. And this is where I think it's worth giving you an updated kind of thinking on how to invest in this market and the real estate market. So many of you know this, I love buying single family real estate. There are great opportunities where if you have great connections, you can get multifamily real estate under market value if you get properties that have under market value rents. Sorry, there are a bunch of people screaming in the pool and it's a little loud. If you could get multifamily real estate under market value, hey, great, and that's awesome. The way you do that again is you've got to find properties that are being sold, ideally that are fixed up and the rents are low. Personally, I find when I look at most real estate funds and syndications, obviously I can't say all because I don't know all, but most of the funds I look at, they're looking for properties that are just, where can we plop $50 million and buy $150 million building? And they're just buying properties from people who are selling these projects for excessively high prices. In my opinion, folks are buying sort of at peak market. Some of these fully renovated, fully rented, fully market rent ready, multifamily real estate properties. And that's where I still believe there's this really unique opportunity. And it's something everybody can really do, especially if you're heavy into investing in the stock market. Everybody could get involved in buying single families. Now, I know that some folks are like, oh, but it's harder to manage or there's less scale. Look, you get pros and cons with everything. Sure, single family homes might not all be next to each other, but in our experience, there's way less management intensity with single family homes that are fixed up and ready to go because most people just leave you alone. Whereas with multifamily, you've got neighbor disputes that you're arbitrating frequently, and you tend to have more of a revolving door with units. You're generally over there more because you're re-renting the units at a higher rate because they're smaller. So those are just some quick differences. And this isn't to bag on multifamily, don't get me wrong. I own multifamily, I get it, like it's fine. But why am I mentioning this multifamily, single family talk now? Well, it's because I believe that if we do see, which I believe, the Federal Reserve starts tapering, interest rates don't start going up until maybe 2023, or quite frankly, could even be 2024 if we start getting lower inflation again, like I expect. Then I believe that as we slowly start seeing the real estate market chillax a little bit, because remember, we're seeing pending sales go down, and that's a sign that we're going to probably start building up inventory again. We build up inventory again, more supply gets built up. That means we're likely to potentially see prices come down a little bit. If prices come down again a little bit and sellers all of a sudden have less power, I think the opportunity to get good deals in real estate is going to be much more plentiful. We'll have more options. We'll have more frustrated sellers who are like, man, I thought it'd be easier to sell. Now it's not as easy to sell. And maybe those are going to create opportunities to go shopping and buying again. That's what I'm looking for. Now, I did just buy a property a few months ago. Actually, I think it's about 9 weeks ago now. We're about to put it on the market for rent. I'll have to do a before and after on that. I've got the before footage, but I never went back to film it again. So I have to do that. And I'll show you this property I bought for $570,000 in like a $715,000 neighborhood. But anyway, these are the kind of deals that I'm looking for. And I think it's going to be easier to get more of these. Now, why don't I just try to go get a big multifamily building? So I've thought about that as well. I've been thinking to myself, like, oh, should I just go buy a big multifamily building somewhere? Well, first of all, I think the odds of me getting a good deal in multifamily on a big building that's on the market, very low, unless I could get it again below market value rent. I don't know if I could find that unless I go move to an area and I know all the agents in an area. I think if I really put the effort in, I could probably find it, but then I'm also not an expert in other areas. Like if before I ever bought real estate in an area, I probably want to be there and understand the neighborhoods, understand the people for a good 6 months, and go to all the different bars, go to all the different clubs, go to the different restaurants, talk to the people there. Hey, look, the funny thing about when you go to bars and restaurants is people are very willing to talk very candidly about the good and bad of different areas. I like doing that, by the way, for even just political research, because again, people are very candid about the problems that are happening or things that are good in an area. So just strategies to think about that work also for real estate. But anyway, that is leaving me in this place where, okay, well, what if I just go back into buying real estate more so than I've been buying stocks? And what if I'm wrong about inflation? See, that's another big piece here. What if I'm wrong about inflation? All right, so let's analyze this. First, if I'm right about inflation, then I don't think we're going to see rates go up, and I think we're potentially going to see a little bit of softening in pricing as supply goes up for real estate, and I think I'm going to be able to get more and better wedge deals in single-family real estate. Again, real estate where I'm buying below market value. If I'm wrong about inflation, which of course I can be wrong. I've been wrong many times before, and I do my best to learn from all my mistakes and make those as transparent as possible. So if I'm wrong about inflation, and we end up having larger or high inflation, then I think, first of all, stocks are, especially the tech and growth stocks I'm in, their future earnings are going to get sort of discounted much more heavily, and the market could pull back. We could have a very bad few years for like Cathie would, ARK Invest, and even the growth plays that I have. Again, because if we see higher inflation, well, it's going to be a problem. We'll expect to see higher rates from the Fed. We'll see, more earnings discounting. It'd be a problem. But what's interesting is if we see higher inflation, one of the easiest ways to hedge yourself against higher inflation is owning rental real estate. So if I can get into below market value rental real estate, because we're going to, maybe we start seeing a little bit of a supply backlog coming up finally, which we desperately need that. I get a little bit more negotiating power with some of the sellers who are just asking ridiculous prices right now. Then I could actually load up more on single family real estate, getting good deals, and hedge myself for inflation. Why? Because I'm locking in 20, 30-year fixed rate debt at today's pricings, which is actually really exciting. And today's pricing, that is today's interest rates, right? So I take advantage of having better leverage opportunities with sellers, but then also cheaper financing. Cheaper financing means I'm locking in 4 or 5% debt. If you're a homeowner, you could lock in 2.8, 2.35% debt. I have to unfortunately get commercial financing, so it's a little bit more expensive for me because we can't get conventional financing anymore. We have too many properties. I mean, it's a good problem to have, but it just means I get crappier financing. But even still, if I can lock in debt at 5% even, and then let's say we have hyperinflation, generally assets benefit, and the appreciation of assets rides on top of an inflation wave. And hard assets like real estate do very well. You're able to pay your rent off with inflated, you're able to pay your mortgage off with inflated rents, because if we end up seeing hyperinflation, then I do think that rents are going to come up substantially. In fact, one of the things that could quite frankly drive up inflation, and where I could be wrong, could be substantially higher rents, which again would be phenomenal to own more real estate in. So I'd lock in a payment. Price appreciation, I think, would be better in the long term under a hyperinflation or large inflationary period. In inflation, it'll be worse for stocks, or in real estate, it'll be better. And rents would go up, which would give me more cash flow or more negotiating power when it's time for rental increases every year at lease renewal time. So in a crazy way, what I'm saying in this video is, while there is so much uncertainty in the stock market and I'm diamond handing the stock market, I think there could be some very unique opportunities that if real estate starts backing up a little bit more, again, more inventory, more leverage power with sellers, and I can lock in whatever rates I can lock in now before Powell makes any kind of changes on rates, then I think I can, again, get good deals on wedge deals again. It's probably the most conservative, easiest way to get sort of a compounded annual return on your money of 10 to 15%, which is pretty good. You know, that's kind of like a Cathie Wood ARC goal is 15% as an annual compounded goal, unless there's a big market dip, then she bumps it to 25% because she's justifying buying the dip, which is fair too, totally fair. But I protect myself if I'm wrong. So like, if I'm right about lower inflation and lower rates, great, I have more time to acquire. If I'm wrong, I'm hedging my stocks with real estate. So right now I've got about 50% of my wealth in real estate, 50% in stocks. Now, I do want to also provide a little bit more clarity about cash flows in real estate. I don't really care about cash flows in real estate. I'm a very different kind of investor. What I'm looking for is long-term wealth. And when I buy properties $100,000 under market value, I don't really care if there's no cash flow. Quite frankly, I'd rather have zero cash flow because it means I'm not paying those taxes. Over time, you get more cash flow as rents go up, right? But if I'm buying something at a break even or even a slight negative, $100, $200 a month, that's really good, in my opinion. Because, okay, so say you have a $200 negative cash flow, that's $2,400 a year of negative. But if you just bought a place $100,000 under market value, first of all, if the market continues the way I expect, even just nominally, not at this unsustainable 15-20%, but even if we just have 2% growth, well, geez, 2% on a $600,000-$700,000 property is $12,000-$14,000. Who cares? Like, whatever, $2,000 negative, right? Big deal. It means I'm not paying taxes. In fact, I'm taking more tax write-offs, more tax benefits, which is a good thing. While also locking in that wealth, which then I can unleash or unlock tax-free through refinancing. But only when rents have gone up. So that way you're not, because the last thing you want to do is be going massive negative into real estate, right? You don't want these massive, what you don't want to have ideally is a portfolio where you have like 10 properties or 50 properties and they're literally all negative, because that's a lot to sustain. That's a lot of burden on your shoulders, right? But let's say you started with your first property, a couple $100 a month negative. After 2 or 3 years, you buy your next property. And your first property, you've raised the rent $50 a year or whatever, or however, and now you're break even. And now you're break even on that one, or you have a slight cash flow, $100, $200 cash flow, whatever, however it works out. You buy your next one, you make sure you're able to sustain whatever kind of portfolio neg you have. And again, I'm not here trying to make a video going, oh, get rich quick by having negative cash flow. It's like, no. I just mentioned this because I understand a lot of folks, they leave me comments and they're like, well, how, if I buy rental real estate right now, I have a slight negative. What do I do? And so in my opinion, you protect yourself with having a very, very good deal. The worst thing I think you could do is buy a property that is market value and has a negative cash flow. That's horrible. That would be the worst thing you could do. I would recommend against that highly. However, then again, there are plenty of people who bought market value real estate in November and they're up 10% right now because the market just appreciated that much. That's just fluke. I don't like to plan on market appreciation. That's the icing on the cake, right? That's why I like getting properties under market value. You get these massive boosts in your net worth. And that's usable at times of crises, like what we saw in March of 2020 when I refinanced a bunch of properties, took that money and went buying stocks. So anyway, there you have some insights into my current thoughts. I really appreciate you watching this. This was definitely a longer video than I expected, but hopefully you enjoyed it. It's a big old one take. Now let's see if I can upload this longer video Wish me luck. Thanks for watching, everyone. We'll see you in the next one. Make sure to go to my Bakersfield rally at meetkevin.com and check out the amazing programs linked down below. Get that 40% off coupon code on all of the programs, or any of the programs. You can mix and match them too with the bundles we have on building your wealth. So that's going to include programs on real estate investing, do-it-yourself property management, stock psychology, money, real estate agent sales, and making YouTube videos, making money from, I may have already said that, or do-it-yourself and rental renovations, property management. Thanks so much, folks. We'll see you in the next one. Bye.